What's up, everybody? We got the 2026 market outlook that I'm going to run through with you guys. We're going to talk about the economy, the stock market, impacts from midterm elections historically on the markets. Also, when the Federal Reserve cuts rates near all-time highs in the stock market, what historically happens. So got some great charts, got to stick around for that. But let's get into it right now so you can see what's going on with our projections and so forth. And this is by LPL Financial. So first of all, gross domestic product. We expect this to come in somewhere around probably 2% on average for 2026. And because that's coming off of $28 trillion, multiply that times 2%, somewhere in there, $500 to $600 billion worth of goods and services being produced in the United States, which is really insane. And then people talk, oh, we're going to run into recession, stuff like that, and lose 2 or 3%. That's about 700 billion. And we're already still producing 20 trillion plus. It's just crazy when people talk about recessions. Anyway, next thing up on the board is intellectual property is going to be continuing to grow. LPL believes. I also believe in this. This is AI, artificial intelligence, now representing 7% of growth in the United States. You got consumer spending up here at 24. On goods and services, 45. Then we come in right here, intellectual property at 7%. We think that'll continue to expand and help the economy longer term. Might run into some near-term pain here with some inflation. You got the manufacturing index increasing up a little bit, closer to 70 mark on the left axis. But the CPI, consumer price index, has been dropping here and really not trending back up like the manufacturing index. And part of that's going to be tariffs in this situation. But as you can see, we got up over 9% during COVID and came all the way down here. Now we're at that 2 3/4 mark, which is really in line with where the Fed's trying to get to on the Federal Reserve rates, eventually moving down. Another key thing impacting the economy is the 10-year Treasury, which is the anchor, as it says, for mortgage prices. Coming back down now, we're getting close on the 10-year Treasury in that we got slightly under 4 at one point. Now just slightly over 4%. This is the key driver to mortgage rates. We were up in the 7, 8%. Now I think in the mid 6s, low 6s. I think we're projecting probably by year 26 year end, maybe in the high 5s, which that could be a huge impact for the housing market, which then could be a boom for anything that's tied to that. Overall projected growth for us, 2%, 26, 27, 2.2%. And you can see the rest of the world, except for maybe Asia, emerging markets, overall global 3% in 2026, 2.9% in 2027. And there's some things going on here in Japan and Asia that, is it worth it? We're making our bets still here in the United States. You're still going to have exposure if you got S&P 500 to international markets because about 50+% of the earnings from these companies are coming from international areas. Anyway, stocks. Policy tailwinds, we think, and AI to power equities in 26 going forward. And if you look at bull market runs, historically going all the way back to 1950, the different cycles of bull markets. So like in year 1 is the black, year 2 is the red, year 3 turquoise, and we got year 4 a lighter sky blue bull market. So here we are currently in the bull market. Year 1 up around 20+%. Year 2 we're up over 30. Year 3 up around 16. Now we're going into year 4 right now. The average year 4 in a bull market is about 12.8%. So there's only been one time when it's been down. That was back in 1949. Ending there down 2.3%. But the average has been about 12.8 on that 4th year. And we're in the 4th year of a bull market again, guys. And that's after the market has recouped a 20% plus drop, which is a signal of a bear market. We are back up. So technical trend here could be good for this next year coming up too. Then as far as performance of the S&P 500 when the Federal Reserve cuts rates. All right, this is the S&P 500 at different terms here. Performance after the Fed cuts rates at near record highs. And when there's no recession, you can see this light blue line all the way up here on the top going up over 18.2%. Then you have cuts with a recession where it drops down, it breaks even about down over here about 2.7%. This is after 12 months here, guys. 12 months of performance on the S&P 500. Then all cuts right here, up basically 13%. So we think this chart, technical wise, also another strong indicator we could have some movement. All right. AI investment by hyperscalers. And what we mean by that, hyperscalers here is going to be like Alphabet / Google, Amazon, Meta, former Facebook, Microsoft, Oracle. The spending by these companies has just been growing phenomenally, and we think it's going to continue to grow. As you can see here in 2026, Oracle, Meta, just massive amounts, 400 billion, 500 billion. Total investment still going in and even to 27. It could be that's because you're going to see this next chart, which is insane, the impact on the earnings for the S&P 500. Let me show you this. So earnings driver, if you look at the blue here, this blue number is the earnings growth year over year of the S&P 500, including the Mag 7, which again, Google, Amazon, Meta, NVIDIA, Microsoft, Tesla's in this, Apple. So back in 24, 50% right here, earnings growth. And if you took out the Mag 7, actually lost in 2024 Q1. You go to Q4 right here in 2025 forecast, still looking at almost 20% growth on those Mag 7 stocks. And then you've got the rest of the S&P without it, not much growth at all. So that is a key driver. We see that continuing to happen. We're probably looking at the S&P 500 growing somewhere in the low double digits, where we end up maybe 7,300 to 7,700 type range is our base case scenario, depending on certain things. Now, there's some black swan events that could happen, right? That could take that down. And you're going to see coming up in a midterm election year, typically is the highest volatility of a stock market during that year. And that's a big impact on how we manage money too. So let's take a look at this in here as well. If we take a look at midterms, what this chart is showing right here is the average return of the stock market is in blue during a midterm, and then the average max drawdown when the market drops during the midterm election year, and then the realized volatility in the marketplace. How much fluctuation are you getting in these different cycles? And you can see on this guy right here, during the midterm election year, biggest drawdown period typically, well over 15% historically during the midterm election. So this is why when we're building portfolios, we're striving to get hopefully double-digit growths in our growth portfolios or more. But if the markets drop, how do you protect against that? We have strategies that we use to strive to do that for our clients to keep their cortisol levels low, so we're not increasing any inflammation in the body during that. But the average upturn you can see is a little bit under 10%, which is where our base case is of growth rate in a midterm election. That would be the case regardless based on what we're seeing. But then in that next year, the pre-election year, a lot less volatility, huger gains typically on average. So if we can get through this year, prevent any major losses, depending on what we see on those midterm elections, could have some interesting upside for that following year in 2027. All right, guys, let's look at the federal funds rate predictions. Probably we're seeing around that 3% to 3.25% range from where it is right now. So that would take it down 50 basis points more down. What does that do to bonds? If we get a drop in rates of another 0.5% to 1%, expect total returns on these different categories anywhere from 7.1 on the U.S. aggregate bond index to mortgage-backed 7.2 to 9.8. You could see some high single-digit returns in these bond areas. So we think probably in this range, between no change to a half, is where you're seeing in here to clip some coupons on there. It would take a lot to where the rates would have to go back up. There'd have to be some kind of collapse in the credit markets, something unforeseen in the U.S. That would say, hey, we need to attract capital, so we've got to raise rates back up or inflation just goes out of control again. Not seeing that right now. All right, so now I want to hit on currencies here when we talk about the U.S. dollar. there are a lot of people out there that say the US dollar is not going to be the world's reserve currency anymore. I'm going to show you some data here that really points to that's not a concern right now. Trending a little differently, yes, but is it going to go away as far as the world's reserve currency? Let's take a look at some numbers. I want to show you this right now. So let's pull this up so you can see this as well. We look at this here. What this is showing is the dollar is down but not out. It's being disrupted. And so there's some big things that have happened here recently in 2024. It fell like 10% in the first half of 2025, which was really, that's the worst start ever since 1973. But the decline was triggered by a series of policy shocks. First, beginning with the Trump administration, they invoked the International Emergency Economic Power Act in February. That was aimed to regulate international trade under a declared national emergency. That rattled markets, undermined confidence in the dollar, and then additional pressure came in from Germany's major fiscal stimulus package, which boosted the euro and released the DeepSeek R1, a reportedly more cost-efficient AI model from China. That raised questions about U.S. tech dominance and American exceptionalism. And then on April 2nd, dubbed Liberation Day, the global sweeping tariffs came out, which that obviously put a little bit of damper in things as well from that standpoint, which then really sparked a near bear market. Equities dropped almost 18-20%. Then surprisingly, traditional safe havens like U.S. Treasuries and the dollar failed to cushion the sell-off, breaking their historical roles a hedge against equity risk. So yeah, that's really a perfect storm that happened back then. But then it started a trend back up as far as here recently. But we're still in this secular uptrend all the way back from 708 when you had the massive mortgage crisis, debt crisis going across the world. And you can see it's still up here, and we haven't even, like 2020 during COVID, but jumped back up. It literally accounts for about 89% of all foreign transactions. About half of that's export, half of it's imports out there. So all foreign exchange transactions, you still have to have a dollar if you want to do business with the United States. So we don't think that's going to be going anywhere anytime soon. So now I want to shift my attention towards, if we get this AI influx and we get this more productivity and we get more growth and all that, what could happen here? Could impact commodities and then also gold too some more. So we're going to take a look at this. If we pull this up here, new commodity playbook, geopolitics, AI, and a path to a super cycle. If we look at this, commodities, we think potentially on the verge of a breakout inside of here. So you can see these key resistant levels. If we can break through this in here, could see a push back up like we did during the back end of COVID in here too as well. All right, so let's take a look at the gold impact, or what's been going on. Gold and silver's doubled from like 25 to over 50. Gold's from over 2,500 to 5,000. A lot of these things, geopolitics have played a huge impact. The tariffs impact, the One Big Beautiful Bill Act impacting things. And we're really seeing from the World Gold Council, there was a survey showing 95% of central bankers really expect gold reserves to increase over the next 12 months. And while really nearly 3/4 expect the dollar reserves also to decline over the next 5 years. Again, not going away as a world reserve currency, but declining. Been in there, but really it's been supported by safe haven demand, really conflicts in the Middle East, the trade policy uncertainty, passage of, as I mentioned, the One Big Beautiful Bill Act, and then renewed fiscal deficit concerns because of that. And then you had the growing U.S. critical minerals list was introduced, potential federal funding for like domestic mining projects. That could provide another catalyst for broad metals market as well. So in there. So looking to continue to have portions of the portfolio look into gold as well out there. Hope you guys like this. Here's my disclosures out here. I've got to roll out so you can see them on the board. I'm up here. I'll get out of the way, but we greatly appreciate it joining on. I hope this was valuable, and we'll look forward to seeing you on the next video. Appreciate it. Thank you.